What if you could combine the power of the biggest tech companies with the explosive potential of Bitcoin, all inside one simple portfolio that generates monthly income? Most investors think you need to pick a side, traditional growth stocks or crypto. But today I'm going to show you how QQQI and BTCI can actually work together to give you both stability and monthly income. This is BAT's Dividend portfolio, and today we're looking at a unique mix that brings together tech and crypto in a way most people don't consider. QQQI is an ETF on the Nasdaq 100 that uses a covered call strategy, which means you get exposure to giants like Apple, Microsoft, and Nvidia while also collecting higher monthly income. On the other side, BTCI applies the same covered call strategy but on Bitcoin futures, turning one of the most volatile assets in the world into a consistent cash flow generator. The combination is interesting because it balances stability from tech with the upside and energy of crypto, while still giving you reliable dividends every single month. When we look at QQQI, the best new active ETF of the year, we're essentially looking at an ETF that gives you direct exposure to the Nasdaq 100, which includes some of the biggest names in technology and innovation like Apple, Microsoft, Nvidia, and Amazon. But QQQI doesn't just hold those companies and wait for them to grow. It actively sells call options on the Nasdaq 100 index. By doing this, it collects option premiums every single month, which are then distributed to investors as income. That's why QQQI pays out monthly dividends that are significantly higher than what you'd get from simply holding QQQ. In addition to this income strategy, QQQI also aims to be tax efficient by using Section 1256 contracts on index options, which in the U.S. are treated with a favorable 60-40 tax rule, and by looking for opportunities to harvest losses. The result is a fund that provides steady monthly cash flow, potential capital appreciation from the Nasdaq 100 itself, and some built-in tax optimization. The trade-off, of course, is that because the fund is writing covered calls, your upside is capped. If the Nasdaq takes off, you won't fully capture all that growth. BTCI, on the other hand, takes a similar philosophy but applies it to Bitcoin. Instead of directly buying Bitcoin, the fund invests in exchange-traded products that track Bitcoin, and then it sells covered calls on Bitcoin futures and related instruments. This strategy turns the massive volatility of Bitcoin into a source of consistent income. Like QQQI, BTCI distributes dividends every single month, and because of the extreme volatility in crypto, the yields can be even higher, currently over 20% annualized. That's a huge cash flow generator compared to most traditional funds. But it's important to understand that the risk is also higher. Bitcoin is an emerging asset class, still subject to regulatory changes, market shocks, and liquidity issues in derivatives markets. The fund is also newer, so it doesn't have a long performance track record yet. And, similar to QQQI, most of its distributions are classified as return of capital, which has tax implications you need to consider. When you combine these two funds, QQQI and BTCI, you're essentially pairing two different engines. One engine is tech, backed by the most powerful companies in the world, delivering stability and growth potential. The other engine is Bitcoin, highly volatile but capable of massive upside, and through BTCI's option strategy, converted into consistent income. Together, they create a portfolio mix that is unique. Monthly cash flow, diversification across both traditional and digital assets, and a balance of stability and risk. You won't capture the full upside in raging bull markets, but you will have a predictable stream of income while still participating in two of the most important growth themes of this decade, technology and crypto. I'm not a financial advisor, and nothing in this video should be taken as financial advice. I'm simply sharing information and analysis so you can make your own decisions. Always do your own research and consider speaking with a professional before investing. That said, there are important risks to keep in mind. Both QQQI and BTCI rely on a covered call strategy. This means you're trading unlimited upside for consistent income. If the Nasdaq or Bitcoin go on a massive bull run, you won't capture the full gains because the options cap your upside. On the flip side, the income keeps coming in, but it doesn't protect you from market downturns. If tech stocks or Bitcoin fall sharply, the value of your shares will also go down. There are also risks specific to each fund. For QQQI, the main concern is that while it provides stability through the Nasdaq 100, a recession or slowdown in tech could still hit the fund hard. For BTCI, the risks are even greater. Bitcoin is extremely volatile. It's influenced by regulation and global sentiment, and futures markets can sometimes create additional costs or liquidity problems. On top of that, both ETFs classify most of their distributions as return of capital, which can complicate your taxes if you don't understand how it works. So while these funds are designed to generate strong monthly income, they're not risk-free. They should be seen as part of a broader strategy, not a one-size-fits-all solution. To wrap things up, the combination of QQQI and BTCI gives you something unique: steady monthly income, exposure to both the world's leading tech companies and the explosive potential of Bitcoin, and a balance between stability and volatility. You won't capture all the upside in a raging bull market, but you'll get consistent cash flow while still being invested in two of the most important growth stories of our time. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss future breakdowns of high-income ETFs and dividend strategies. And I'd love to hear from you in the comments. Would you add QQQI and BTCI to your portfolio, or do you prefer the classic approach of just holding QQQ and Bitcoin directly?